Okay. We're going to talk tonight about deducting business expenses.
All right.
Go back and refresh your memory a little bit. If you receive a W-2, you're considered an employee. If expenses you have are reimbursed under an accountable plan, and we'll talk about what all constitutes an accountable plan a little bit later, they're not income to you and are not deductible by you. For the years 2018 through 2025, unreimbursed expenses are not deductible. Prior to 2018, they were deductible on Skip 2106, which would flow to Schedule A and be subject to 2% of adjusted gross income limitation. And through 2026, that's supposed to be the case again, but Congress could always change before 2026 comes around and make that, make the 2026 and later like 2018 through 25. If you get instead a 1099, you are self-employed and your expenses are deductible on Schedule C. So depending on what you are is where on your tax return those would go. Business expenses, so the best thing to do is have a deductible, accountable plan that the church sponsors, and you have reimbursements done that are not income to you, but neither do you get to deduct them. Personal vehicle, if you use your personal vehicle for business use, commuting is not deductible or reimbursable. Commuting is you going from your house to your place of business, or you going from your place of business back to your home. And commuting is not deductible item. You have the first choice that you make in the first year of vehicle use, either when you buy a new vehicle or you use a vehicle for the first time for business. You can take actual expenses and you add up all your actual expenses, fuel and repairs and maintenance and insurance and car tags and taxes on car tags, et cetera, et cetera, et cetera. You need to track your business mileage, and you would take your business mileage. If you had 1,250 miles business use out of 12,500 miles, then you have 10% business use. So you would take your actual expenses times the business use percentage, and that would be a deduction you would have. Or you could take a standard mileage rate. For this year, for last year, it's 58.5 cents a mile through June 30th. When we saw gas prices going up in the latter part of the year, the IRS decided that for the latter part of the year, they would make it 62.5 cents a mile. For 2023, it is back down to, it is back up to 65.5 cents a mile for 2023. So the standard mileage rate, you would just take every mile you travel for business, and that's what you would claim as a deduction there or reimbursement there. Parking fees and tolls are reimbursable or potentially deductible. Now, you will hear me say throughout this presentation that they are potentially deductible or deductible, but then keep in mind that we're in a different phase in 2017 through 2025, and that you don't get the deduction unless you're self-employed and filing Schedule C. Commuting. Any mileage incurred between your home and your primary location is commuting and is not deductible or reimbursable. If you qualify to deduct a home office, you can possibly qualify to deduct or being reimbursed for mileage between your home and the church building. But we'll talk a little bit more in detail about what it takes to qualify for a home office in a few minutes. Once you have arrived at your primary work location, any mileage incurred conducting business is either deductible or reimbursable. So if you go from your house to church and you have an office at the church, then church is considered your primary work location. And if you go visiting the sick or visiting the hospital or visiting shut-ins or whomever, or having a session with someone who's not a member, you know, just anything you do that's work related, that you go somewhere else, then that mileage would be conducting business. You should track that mileage and either get standard mileage rate or a business expense deduction. Your first stop of the day is at a location other than your primary work location. So if you leave the house and you stop by to see the hospital to see somebody who's sick, then that's your mileage from your house to the hospital would not be deductible. It's commuting mileage. From the work you started there because you visited somebody that was sick, from there going to the church building and going from there going somewhere else to visit someone else would be business mileage, and you should track that mileage and get reimbursed for it. If you depart, you're on your way home and you go not from the office, but from the hospital home, then the mileage to the hospital is business mileage. The mileage from the hospital home is commuting mileage, and that would not be deductible or reimbursable. This is true if for anything. These are the IRS rules that apply no matter what business you're in. If you combine business and personal travel in a single trip, you must allocate the expenses between the business and the personal portions and can only deduct or be reimbursed for the business portion. The allocation must be made on a reasonable basis. A percentage of time that was spent or the number of days it was spent, whatever is a reasonable basis. but the deduction or reimbursement cannot exceed the amount you would have incurred had only business travel been involved. So if you, I'm a CPA and I go somewhere in 2017, I think it was. My wife and I went to Hawaii, and I took 5 days of continuing education. I could deduct, and we'll get into a little more. Well, let's go ahead and see the second. When counting business versus personal days, travel days, weekend days are not considered. So we'll go into an example there. If your spouse or children accompany you on a business trip, you may only deduct the expenses incurred for those who were involved in the business. If you go to PTP and you fly up there, but your wife is also conducting a women's class, so the flights would be deductible for both you and your wife because you're both doing something up there. If your wife is not teaching, if you're only holding seminars, then only your cost. But if however, no additional cost was incurred, for example, you drive instead of fly, you can deduct the full amount because there's no additional cost to carry your wife with you. So back to my illustration earlier. My wife and I went to Hawaii. We traveled to Hawaii on Thursday, a 10.5 nonstop flight from Atlanta. And we got into Hawaii. It was Thursday afternoon, about 2:30 their time. Wiped out. On Friday, we stayed in the Big Island because we flew into Honolulu. Saturday, weekend day, doesn't count. Sunday, weekend day, doesn't count. On Sunday, because we traveled to Maui on Sunday, which is where my classes were being held. We traveled to Maui on Sunday. Monday through Friday, we were in Maui, on Maui. And then Saturday, we came back to Atlanta. Stop over in Dallas, flew into Atlanta. So out of the 10 days approximately that I was gone, 4 of them were weekend days. 1 of them was a travel day. So that only left 6 days, 10, 11 days that I was gone. So 6 days that we traveled on our trip, and 5 of those 6 days I was in class. So in that situation, I could have deducted 5/6 of my cost, could not have deducted my wife's plane ticket, but I could deduct 5/6 of my cost because I was in class 5 of the days and not in class for 1 of the days. Not counting weekend days, not counting travel days. So I think you can see how this works. If you go for a trip down, if you go to polishing the pulpit, If you go, they start generally on Friday. So that's a travel day for most people. Saturday and Sunday are weekend days. They have classes Monday. They have classes Friday through Thursday, but Monday through Thursday, you have classes. So if you got asked to speak, you could do, all your trip may be fully deductible because you're asked to speak, you're doing work, and because you're there, not on the weekend, not on travel days, you don't count those. So every day you're there, you're doing something. So you could be, now if you're holding a gospel meeting somewhere and it's Sunday through Wednesday or Thursday through Sunday, your travel days you don't count, your weekend days you don't count. If you're doing gospel meetings those other days, weekdays, 100% of your expense could be deductible. Even if you took, say you drove there and you stopped somewhere and you decided, to spend 2 hours or 5 hours at the Creation Museum in Kentucky, or, if it's a travel day, you don't count it. So whatever you do those days doesn't count.
Okay.
Okay, for meals and entertainment, they must either be directly related to the active conduct of your business, or they may be associated with the active conduct of your business in order to be deductible or reimbursable. So I'm a CPA. If I go meet a client and we have lunch somewhere, that's directly related to the active conduct of our business. So, or associated with the active conduct of our business. So I could meet a client and write that meal off. Now, they have since changed the rules for entertainment. So entertainment is generally non-deductible and non-reimbursable unless you do meals. For meals, for the last 2 years and for the current year, 100% of the meal cost is deductible or reimbursable. And for prior to 2020 and after 2023, you will be in the situation again where only 50% of the meal cost is reimbursable. But that has a caveat with it, that it has to be a meal in a restaurant or a fast food place. So it can't be a meal where you go buy something and you serve a meal to a client. That would not be 100% reimbursable, but if you went to a restaurant, that would be 100% reimbursable. Directly related expenses must meet the following 3 tests. The main purpose was to transact business. You did engage in business during that period, and you have more than a general expectation of deriving income or some other specific business benefit at some indefinite future time.
Excuse me, Roger. Was your display supposed to be showing that? because you're only showing the GSOP class.
Well, it's supposed to be showing all this stuff. Let me stop share. And let me, now, does that show it now? Let me,
We're on the split screen right now.
hold on. No. Oh. Now, is it showing it?
Yep, deduction of
Okay.
business expenses.
Yes.
Yes.
And I've been supposedly showing it the whole time. So I
Yes.
apologize, but everything that I've said basically has been on the slides. Let's go back. Okay, these are the slides that we've gone through, and that now that I'm sharing those and you can actually see them, I'll
Okay.
go back through them. We talked about commuting. We talked about the mileage rates or the actual expenses. We talked about commuting. We talked about if you go somewhere before you go to business location, then commuting mileage would be from that location. We talked about the allocation of business expenses between personal and business. And I gave you the illustration. And then here's the screen we're on. That directly related must meet the following 3 tests. Main purpose is to transact business. You did engage in business during the period, and you have more than a general expectation of deriving income or some other specific business benefit at some indefinite future time. Okay. To deduct or be reimbursed for associated meals, not entertainment right now because that has been deleted, you must be able to demonstrate that the activity was associated with the active conduct of your business and occurred directly before or after a substantial business discussion. The IRS terms that the clear business purpose test. So you have to have a clear business purpose for doing that. They stopped entertainment because a lot of businesses were spending to have football games or basketball games or professional games like that, college games like that, and wound up with generally the employees of the business enjoying those benefits as opposed to the clients of the business enjoying those benefits. So they said, no, let's stop the entertainment piece and not allow that as a deduction anymore. Books and subscriptions to professional journals are deductible if the item useful life of the item is short. If the item has a long useful life, and we used to talk about commentaries, for example. Somebody buys every issue of Truth for Today commentary that comes out, or buys a set of Gospel Advocate commentaries. The commentaries that would be deemed to have a long useful life, and therefore they should be capitalized and depreciated over 5 years. Alternatively, in lieu of depreciation, you could claim a Section 179 deduction for the item subject to income limitations. But there's a conundrum here. If the church reimburses you for books you buy or commentaries you buy, who owns the item if you got reimbursed for it?
Shouldn't the church own it?
The church generally does own it. Now, you may keep it in your office at the church, and when you leave, they may tell you you can carry it with you as opposed to leaving it. But at the time it was purchased, the church reimbursed it, therefore it's theirs, and they would have the ability to say, yes, you can take it, or no, you can't. Now, if you didn't get reimbursed for it, and if you bought it, I would claim Section 179 or depreciate it under current depreciation rules. Depreciation is 100%. So buy it, and instead of using Section 179, write it off as a depreciable item, and it's yours. And then you don't question who owns it, if you should have to leave, or if you should get an opportunity to take another job, etc.
All right.
We talked a little bit about education expenses. We talked last week about if the church can reimburse you up to $5,250 a year for education expenses, and that is not taxable to you. There are other education expenses that if you exceeded that $5,250, you may, or the church may not choose to reimburse up to $5,250 of education expenses. So you may be under this rule. Education expenses, which are, number one, required by your employer or by law or regulation to keep your salary, your status, or your job. Or number two, maintains or improves skills required in your present work, are deductible unless, one, it is required to meet the minimum level of education to qualify you for your trade or business, or two, is part of a program of study which qualifies you for a new trade or business. So we had someone who was a minister for us, and they decided they want to get a master's degree in counseling so they could provide counseling to not necessarily church members, but to other people other than church members. If they were talking to church members, they would not do it as a counseling session, but instead would do that as an advice to a church member session. But if they were talking to a non-member of the church, they would do counseling for that person. He had a degree from Freed and a Bible degree. That's what he had. He went to Ambridge to take the counseling classes. And because counseling qualified him as a new trade or business, he could not deduct the education expenses. Now, we could reimburse him $5,250 a year. And there were, I think it took about 4 years to do that. There were 2 of those 4 years in which the $5,250 was sufficient for what he spent. But there were 2 years in which he spent more than that. So we reimbursed him the $5,250, but he could not deduct the rest of the education study because it qualified him for a new trade or business. Now, we currently have a minister who has gone to Memphis School of Preaching. So Memphis School of Preaching gave him the necessary qualifications to do the job. So if he takes some additional college work, he's looking at Freed Hardeman. If he takes that, he's improving or maintaining skills required in his present work. So unless he meets the exception 1 or 2 there, that it's required to meet the minimum educational level, which is not, or is part of a program of study that qualifies him for a new trade or business. So if he takes, we'll say a counseling degree, then that would not be deductible. But if he's doing just a Master's of Divinity, then that doesn't qualify him for a new trade or business. And it's not required to meet the minimum educational level for his current trade or business. So his deductions would be perfectly fine as education expenses.
So if you take additional classes and if it does not improve your status, then you cannot use it as a deduction.
If it maintains your skills.
Okay.
If it maintains your skills or improves your skills. So Georgia, Alabama, all the states I've lived in require 40 years of continuing education for CPAs. 40 hours rather, 40 hours every year. In Georgia, I can do a minimum of 20 hours every year, but every 3 years, I have to have 120 hours. So it averages 40 hours a year. Alabama says 40 hours a year. So I can take classes, and as long as they maintain or improve my skills required in my present work, they are deductible. Now, the business pays for the classes, i.e., my trip to Hawaii that we talked about earlier, because I was doing continuing education in Hawaii, and that's why we went, was so I could do continuing education. The particular company I went there, the particular company that was hosting that, hosts those every year. They have another one going in Hawaii this year. They'll have one or 3 or 4 in Florida this year. They've had some up in Maine, just places where you would like to go. And they have classes from 7:30 in the morning to 1 o'clock in the afternoon. And then the rest of the time you can do what you want. So, I find it convenient to go somewhere. Now, I will occasionally ride up to Middle Tennessee. My brother lives just outside Murfreesboro. I will take classes in Murfreesboro. My wife will be with her sister-in-law. Her brother's working most of the time. During the evening, we'll visit with her family and do that. And, she will enjoy that. I will enjoy what I'm doing. I'm doing some of the 40 hours I need to have every year. And so and it didn't cost me any more for her to go because the room's going to be the same cost and the mileage is the same because I drove up there. So it's something that she can go and enjoy the trip and enjoy the time with family. And I can do some education that I have to have. We enjoy it. And the IRS says that's perfectly fine. And I can deduct it.
Okay.
Office supplies and equipment, including computers, may be deductible or reimbursable if they're purchased for use in your job, such as a mileage logbook, or are required by your employer to fulfill your job duties. So if you were preaching somewhere and the church said, we'd really like for every time you bring a sermon that you basically have slides you show us to hammer home your points. And you buy a computer and software. I'm using PowerPoint. That's what I know. So PowerPoint would be deductible. The computer would be deductible because I use the computer to do tax returns, to do stuff for the office, et cetera, et cetera. That's all deductible. Now, if I were a contractor, we're not employed, but bought the computer to do the work for somebody as a, that fulfillment of a job, then the computer may be deductible also. The IRS rule is that if you spent more than $75, you have to have a receipt. And every time you have a receipt, you have regardless of the amount, you have to document the business purpose of what you bought. So an office in the home can be deductible if you use it regularly and exclusively for business, for the convenience of the employer, and as your principal place of business. Now, there are a lot of people nowadays, I know IBM for years, has told their employees, we're not going to provide office space. You can work from home. They meet the regularly. They meet the exclusively, at least the portion of the house that they use for business is exclusive for the business. They meet the convenience of the employer, but they don't meet the principal place of business. Because IBM has a principal place of business and their house is not that place. Many people over the last 3 years have worked from home. And they ask regularly, can I deduct that? The answer is generally no. I find it easier to work from here. And that's all what I did during the pandemic. I came to the office every day and I worked from here because what I would need to carry, what I would need to have at home is so voluminous that it doesn't make sense for me to use a home and not an office. So if the church provides you an office, then you cannot usually show, number 3, the convenience of the employer. And you may not be able to show that your home office is your principal place of business. So another thing to think about there, when we talked about housing allowance last week, if you fully excluded all your housing costs under the housing allowance, remember there's 3 numbers that you compare there. One is the fair rental value of the house and the furnishings, etc., and utilities. 2 is the actual numbers, what it cost you. And number 3 is the housing allowance numbers you put. And my recommendation was that you never have the housing allowance as the lowest number, because the lower of those 3 numbers are the ones you get to deduct. So if housing allowance was not the lowest number, and you fully excluded all your housing cost, then you don't have any expenses to deduct for home office, because they've been deducted as tax-free income. So having a office at your home when the church provides it for an office, I've never seen an ability to deduct anything, especially because the church provided that. Then we get into specialized clothing. The IRS says that any clothing which is of a type required, specifically required as a condition of employment, that the clothing is not adaptable to general or continued usage to the extent that it could take the place of ordinary clothing. And 3, the clothing is not worn as ordinary clothing, can qualify as specialized clothing and be deductible when you buy it, and when you clean and maintain it is deductible. Now, I've had preachers ask me, you mean I can't deduct the cost of buying a suit? To which I answer, well, Can you wear the suit as general clothing and ordinary clothing? Don't people wear suits? I mean, for years, I have worn a suit to the office. Now, with my high blood pressure and I'm cold all the time, I wear sweaters all the time, so I don't wear a suit. But it's not unusual. In fact, IBM in the 1950s, their requirement was that their men had to wear suits and hats for their job. I worked for Bell South for 17 years. We would wear a suit to the office. We would take off our coat when we went into our office. When we got up from our office, we would put on our coat because it was deemed proper dress and attire to be seen in a coat. That's just the way they worked. It was deemed. AT&T built that concept in their employees, and when Bell South spun off from AT&T in 1984, that concept carried forward. So specialized clothing, not suits and ties. Now, specialized clothing might be something a construction worker would wear, because he couldn't wear it somewhere where it would be ordinary wear, ordinary clothing. He couldn't, it's required. I audited, had a friend that was a vice president of a company that sold frozen goods and dry goods to the restaurant business. And for the people who worked in the freezer sections, they knew they had to wear insulated clothing. It's not something they could wear as ordinary clothing. It's something that was required for their condition of employment. So they had specialized clothing that they had to have. And if they had to buy it as opposed to the employer paying for it, they could deduct it as specialized clothing. Okay, telephones. This has changed a little bit with the abundance of cell phones. The IRS used to say that you could never deduct the cost of the first telephone line into your home. Now, for preachers, that can be covered by the housing allowance. But any deduction of additional telephone expenses would be based on proving the business purpose of the expense and allocating the costs incurred between business and personal usage. A cell phone that is provided by the employer is not income to the employee if there are substantial business reasons for the employer to provide it to the employee. I want to be able to get in touch with you whenever, 24 hours a day, 7 days a week. The employer tells you that, provides you a cell phone, then it's not income to you. The employer can deduct the cost of it because he has a substantial business reason. Now, if he can't prove that he might need to get in touch with you 24 hours a day, 7 days a week. He may run into difficulty deducting that if the IRS doesn't agree with him, that there would be substantial business reasons for doing it. But if there are substantial business reasons, the cell phone that you provided by the employer is not income, and you don't have to report it as income. And whether the employer allows you to use that cell phone for personal calls, that's between you and the employer. All right, we talked a little bit last week about the Deason rule. The Deason rule came from a court case in tax court back in 1964. So it's almost 60 years old now. The Deason rule says a minister may deduct ordinary and necessary business expenses. Now, I could change that word minister to anybody may deduct ordinary and necessary business expenses. However, if the minister's compensation includes a housing allowance, which is exempt from income tax, then that portion of the expenses allocable to that tax exempt income is not deductible. It came from, as I said, the Deason case in tax court in 1964. And the quote came directly from the IRS audit guidelines for ministers. Now, let me cover a couple of more things about the Deason rule. The Deason rule does not apply to calculating self-employment income, since housing allowance is added back for that purpose. So you don't have any non-taxable, tax-free income for self-employment income. The Deason rule does not apply to expenses reimbursed under an accountable plan. What I have advised some ministers to do is ask their church to come up with an accountable plan. And instead of giving me a raise next year, put what you would have given me the raise as an accountable plan. And I've got to justify the expenses to you to be reimbursed. But when you reimburse me under that accountable plan, it's not income to me. So if I were making $60,000 a year, and they said, we're going to increase your rate, increase your salary next year to 65. And I said, instead of increasing my salary to 65, increase this to 61 and give me $4,000 of expenses that I can apply for as a reimbursed under an accountable plan. And if they agree to that, I've only got $61,000 worth of accountable of income, but I've got $4,000 that, as long as I spend the expenses, and I've done this enough years that I know that I'll probably come close to spending $4,000. So as long as I account for those expenses under the accountable plan and get reimbursed for them under the accountable plan, it's not income to me. And it's deductible to my employer. Now, churches don't deduct things, but if you work for someone, a business, and you take a trip or you do something or you buy something for the business and they say, I'll reimburse you for it. If they have a written accountable plan, the reimbursement to you is not income. They get to deduct the expense that they reimbursed you for. The decent rule does not apply to other types of tax-exempt income. So, for example, if you put some money in a tax-free bond, then, and you made $5,000 a year off the money you put in that tax-free bond, the decent rule would not apply to that. That $5,000 would only apply to the tax-free income from the housing allowance. So is that clear?
Yes, sir.
Okay. And the way the decent rule works is that tax software has special pages or special screens for figuring the decent rule. You put in the amount of your salary, the amount of your housing allowance, how much your expenses were, and it will calculate how much is non-deductible and how much is deductible. Now, for 2018 through 2025, for employees, there's nothing that's deductible unless they are getting some income on Schedule C. So when we talked about Schedule C income, for example, if you go hold a meeting somewhere, that would be Schedule C income. Or if you go to speak at PTP, or if you all those things that are not work that you're doing at your normal employer would be Schedule C income. And the decent rule would apply to the expenses there as well as the expenses incurred. So we may put the expenses on Schedule C, the decent rule still applies. Okay. We have spent almost an hour doing that. Any more questions?
No, sir.
Okay. I will save this. I will send you a slideshow once it's ready to go, or a video once it's ready to go. And then next week, we will talk about reviewing. We will review things as we've gone over them for the first few classes. Let's see, 1, 2, 3, 4, 5, 6 classes, and we will have the midterm exam. So between now and next week, I've got to come up with an exam. I've got pretty much a final exam already done, but I have to do the midterm. And next week we'll do review, and then we will have the midterm exam, and I will take the review, and then you will be on your own to finish the midterm. Within 24 hours, you need to send it back to me, and I will grade it. Okay?
Okay. Yes, sir.
All right. So let me stop share. Let me